Preparing for FP&A Analyst at PZU interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to an insurance company such as PZU? FP&A turns financial and operational data into decisions. At an insurer such as PZU, I would help coordinate budgets, update forecasts, explain deviations, and translate drivers like written premiums, claims frequency, acquisition costs, and investment income into management insight. The role is not only reporting historical results, it also challenges assumptions, highlights risks, and supports resource allocation across insurance, investment, and support functions. Strong FP&A should make the outlook clearer and actions more timely. While answering, focus on budgeting, forecasting, performance analysis, management reporting, business partnering, and how FP&A connects operational drivers such as premiums, claims, expenses, investments, and capital requirements to decisions. Question 2. How would you build an annual budget for PZU? I would start with strategic targets and a clear planning calendar. Then I would collect driver-based assumptions from business units, including premium growth, policy volumes, claims ratios, commissions, headcount, compensation, and investment returns. I would challenge inconsistencies, reconcile operating plans with financial statements and capital considerations, and prepare base, upside, and downside scenarios. After management review, I would document assumptions, secure approvals, and establish monthly variance tracking against the approved budget. Make sure to cover the planning calendar, strategic targets, bottom-up submissions, driver-based assumptions, alignment between business units, review iterations, scenario analysis, approvals, and controls over versioning and data quality. Question 3. What is the difference between a budget, forecast, and latest estimate? A budget is the approved financial plan, normally prepared before the year begins, and serves as a target and resource allocation framework. A forecast is an updated view of expected performance based on actual results and revised assumptions. A latest estimate is often the most current forecast for a specific reporting cycle, with a narrower submission deadline. I would compare actuals with budget to assess performance, but use the latest estimate to manage the future. In your answer, distinguish the approved target from an updated expectation and explain how each is used for accountability, resource allocation, performance measurement, and forward-looking management decisions. Question 4. How would you analyze a significant unfavorable variance in claims expenses? I would first quantify the variance and separate timing effects from a genuine change in expected profitability. Then I would analyze claim volume, frequency, average severity, product and customer mix, catastrophe exposure, inflation, reserve releases or strengthening, and reinsurance impacts. I would compare actual trends with budget and prior periods, validate the explanation with claims and actuarial colleagues, and distinguish a one-off event from a revised run rate requiring forecast changes or management action. Be sure to mention separating volume, frequency, severity, mix, reserve development, timing, catastrophe effects, inflation, and accounting movements, followed by validation with underwriting and claims teams. Question 5. Which KPIs would you monitor for PZU's insurance business? I would monitor gross and net written premiums, earned premium growth, retention, new business, loss ratio, expense ratio, and combined ratio. I would also track claims frequency and severity, acquisition costs, underwriting result, investment income, operating expenses, cash generation, and capital indicators. The exact dashboard would depend on the business line, because motor, property, life, and health insurance have different drivers. I would always connect KPIs to profitability, risk, and strategic targets. Focus on relevant insurance and financial measures, including gross written premiums, earned premiums, loss ratio, expense ratio, combined ratio, retention, new business, profitability, capital, and cash generation. Question 6. Explain the combined ratio and how you would use it in FP&A. The combined ratio measures underwriting performance by adding the loss ratio and expense ratio. A result below 100% indicates an underwriting profit, while above 100% indicates an underwriting loss before investment income. In FP&A, I would analyze each component separately, investigate movements by product and period, and assess reserve development and reinsurance effects. I would not treat the ratio as a complete profitability measure, because investment income, taxes, capital costs, and business mix also matter. Make sure to define the ratio, explain its loss and expense components, interpret levels above or below 100%, and discuss limitations involving investment income, product mix, reserve movements, and reinsurance. Question 7. How would you forecast insurance premiums? I would forecast premiums through operational drivers rather than applying a single growth percentage. For each product, I would estimate policy volumes, renewal and cancellation rates, new business, average premium, pricing changes, retention, and distribution channel performance. I would review seasonality and historical conversion patterns, then incorporate market conditions and management initiatives. I would reconcile the result to earned premiums using timing assumptions, because written and earned premium growth do not necessarily occur in the same period. Discuss a driver-based approach using policy counts, average premiums, retention, renewals, new business, pricing, cancellations, seasonality, distribution channels, and management or market assumptions. Question 8. How would you forecast claims and loss ratios when the data is volatile? I would begin by separating underlying frequency and severity trends from exceptional catastrophe or reserve events. I would analyze claims by product, cohort, geography, and development period, while adjusting for exposure growth, pricing, inflation, and changes in claims handling. I would work closely with actuarial teams to understand reserve assumptions and use base, adverse, and favorable scenarios rather than false precision. My forecast would clearly identify confidence limits and the indicators that could trigger an update. In your answer, cover historical trends, exposure changes, frequency and severity, actuarial input, catastrophe adjustments, inflation, development patterns, scenario ranges, and transparent communication of uncertainty. Question 9. What is International Financial Reporting Standard 17, and why is it relevant to an FP&A analyst? International Financial Reporting Standard 17 is the accounting standard governing insurance contracts, with measurement based on expected cash flows, discounting, risk adjustment, and the contractual service margin. For FP&A, it changes how insurance revenue, service expenses, and profit emergence are presented and analyzed. I would understand the bridge from operational drivers to International Financial Reporting Standard 17 results, coordinate with actuarial and reporting teams, and avoid confusing accounting timing with underlying business performance. Management dashboards should explain both views clearly. Be sure to mention insurance contract measurement, service results, discounting, risk adjustment, contractual service margin, presentation changes, data dependencies, and the importance of reconciling management views with statutory reporting. Question 10. How would you prepare a monthly management performance pack? I would begin by confirming the reporting timetable, data sources, and required reconciliations. The pack would show actual results, budget, latest estimate, prior year, key KPIs, and material variances by business area. I would use concise commentary explaining causes, implications, and actions rather than repeating numbers. Before distribution, I would perform tie-outs, investigate unusual movements, obtain business owner validation, and tailor the executive summary so senior management can quickly focus on decisions. Focus on data collection, reconciliation, KPI trends, budget and forecast comparisons, variance commentary, business unit insights, executive summaries, visual clarity, review controls, and delivering information on schedule. Question 11. Tell me about a time you improved a financial reporting process. In a previous reporting process, analysts manually consolidated several spreadsheets, which created delays and inconsistent definitions. I mapped the data flow, agreed standard KPI definitions with stakeholders, and built a controlled template using structured inputs and automated checks. I also documented ownership and review steps. The process reduced preparation time by approximately 30%, eliminated recurring formula errors, and gave managers earlier visibility. I would apply the same practical, control-focused mindset in PZU's recurring FP&A cycles. While answering, use a clear situation action result structure and quantify the improvement through reduced manual work, faster close, fewer errors, stronger controls, better transparency, or improved stakeholder usability. Question 12. How do you ensure accuracy when working with large financial datasets? I use a layered control approach. First, I confirm the source, period, scope, and definitions. Then I reconcile totals to the general ledger or approved control reports, test for duplicates and missing records, and perform trend and reasonableness checks. I keep formulas transparent, separate raw data from calculations, and document key assumptions. Before submission, I complete a self-review and, where possible, arrange peer review. Any unexplained difference is investigated rather than adjusted without evidence. Mention source validation, reconciliations, automated checks, control totals, duplicate testing, reasonableness analysis, documentation, version control, peer review, and escalation of unexplained differences. Question 13. Which Excel functions and tools are most useful in FP&A? I regularly use SUMIFs, XLOOKUP, index match, if logic, date functions, pivot tables, charts, and conditional formatting. For recurring data preparation, Power Query can improve consistency and reduce manual manipulation. I structure models with clear input, calculation, and output sections, use checks, and avoid hardcoding wherever possible. I also focus on business usability. A technically advanced workbook is not helpful if assumptions are unclear, outputs are difficult to audit, or stakeholders cannot update it safely. Be sure to cover lookup and aggregation functions, pivots, conditional logic, date handling, data cleaning, scenario tools, Power Query, visualization, model structure, and avoiding unnecessarily complex formulas. Question 14. How would you explain a complex variance to a non-finance manager? I would avoid accounting terminology initially and explain the variance through operational drivers. For example, I might say that claims expense increased because the number of claims rose and average repair costs were higher, then quantify each effect in a simple bridge. I would distinguish temporary timing from a recurring trend and explain the impact on profit and forecast. Finally, I would confirm the manager's operational view and agree actions, such as pricing or claims control measures. In your answer, emphasize plain language, business drivers, materiality, separating facts from assumptions, using a bridge or example, confirming understanding, and ending with implications and recommended actions. Question 15. How would rising interest rates affect PZU's planning and forecasts? Higher interest rates could increase reinvestment yields and future investment income, while reducing the market value of existing fixed income assets. They may also affect discounting of insurance liabilities, customer demand, lapse behavior, borrowing costs, and solvency metrics. I would model the effects by asset and liability category, distinguish realized from unrealized movements, and run sensitivity scenarios. The forecast should show both profit and loss consequences and balance sheet or capital implications, not just the headline rate assumption. Discuss effects on investment income, bond valuations, discount rates, liabilities, customer behavior, borrowing costs, solvency, and the distinction between accounting volatility and economic performance. Question 16. What is scenario analysis, and how would you apply it at PZU? Scenario analysis tests how results change when important assumptions move together. I would define a base case and coherent upside and downside cases, covering premium growth, pricing, claims inflation, catastrophe frequency, expenses, investment yields, and regulatory developments. I would quantify effects on earnings, cash, capital, and key KPIs, then identify management triggers and responses. For example, a downside claims scenario might support tighter underwriting, revised pricing, expense controls, or capital planning. Focus on identifying key uncertainties, defining coherent assumptions, modeling operational and financial consequences, comparing outcomes, assigning probabilities where appropriate, and translating results into contingency actions. Question 17. How would you assess whether an expense is genuinely under control? I would not conclude that expenses are controlled simply because actual spending is below budget. I would separate timing, accrual, and one-off effects from sustainable savings, then analyze costs by category and operational unit. Useful measures could include expense per policy, claims cost per case, headcount, productivity, and vendor rates. I would also check service levels and deferred spending. A credible saving should persist in the latest estimate and be supported by an identifiable operational action. Mention absolute and per unit analysis, fixed versus variable costs, timing effects, accruals, headcount, productivity, inflation, service levels, and whether savings are sustainable rather than merely deferred. Question 18. How would you handle conflicting deadlines from several stakeholders? I would first clarify each request's purpose, deadline, dependency, and decision impact. I would prioritize regulatory, board, and close-related deliverables, while identifying work that can be simplified or sequenced. I would communicate a realistic timeline, confirm expectations, and provide an interim output if that helps the stakeholder. I would not sacrifice key reconciliations or review controls to appear faster. If priorities remained incompatible, I would escalate early with clear options and consequences. Be sure to mention clarifying urgency and business impact, agreeing priorities, communicating capacity, protecting critical controls, setting realistic milestones, and escalating early when deadlines genuinely conflict. Question 19. Why do you want to work as an FP&A analyst at PZU? I am attracted to PZU because it combines the scale of a leading insurer with complex drivers across insurance, investments, distribution, and operations. FP&A would let me apply financial analysis to decisions that affect profitability, capital, and long-term growth rather than producing reports in isolation. I also value the opportunity to work with diverse stakeholders and deepen my understanding of insurance economics and International Financial Reporting Standards 17. My strengths in structured analysis, accuracy, and communication fit that environment. Connect your motivation to PZU's scale, insurance complexity, Polish and regional market presence, analytical development, stakeholder exposure, customer impact, and your ability to contribute through disciplined financial analysis. Question 20. What would you do in your first 90 days as a PZU FP&A analyst? During the first month, I would learn PZU's strategy, organizational structure, reporting calendar, systems, KPI definitions, and key controls. In the second month, I would review prior budgets and forecasts, understand recurring variances, and meet finance and business stakeholders to learn their needs. By the third month, I would own assigned deliverables reliably, identify a practical process improvement, and present evidence-based observations. My priority would be credibility, accuracy, and understanding before recommending major changes. In your answer, cover understanding strategy and reporting calendars, learning systems and definitions, meeting stakeholders, reviewing prior forecasts, identifying quick wins, delivering reliably, and building credibility before changing processes. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.